Right, hello, you lot, Group C. You've had a long day today. You've had an assessment with Tim. You've had me talking about Boris Johnson and GDP, TNI, and all that kind of stuff. And now you're stuck with me for a twilight lesson, or whatever we want to call it. So I'm going to try and keep this as short as possible, and I'm not going to set you with too much work for today. You've had a tough one. But there we go. So what we did this morning, we looked at ways to measure economic growth. All I'm going to talk to you about this afternoon are further measures as according to the specification. So the objective is to recognise further ways in which an economy can measure its growth and performance other than just the GDP measure. A point to note, I'm going to set you an exercise looking at things like growth, inflation, unemployment, and something called the balance of payments, which compares imports and exports. These are called measures of economic performance. We're going to do a whole lesson on this, okay? So even if I refer to these terms, we're not going to do it in too much detail today, but we'll do this in future lessons. What did we do this morning? Written definitions of. All right, you feel free to jot this down. We know about short-run economic growth. We know about long-run economic growth. Short-run within a year, long-run 1 year to infinity. We know what GDP is. We watched that video and we worked it out this morning. Nominal and real. So we speak about the idea of one working on monetary rates. Prices are always changing every second of every day. And then we looked at the idea of real GDP as well, using an average price, total national income, and national income per capita. Well, we spoke through that as well this morning, and the idea of per capita means taking your national income or your GDP, dividing it by the population, so you get an average of what each one's worth. One thing we didn't mention this morning is that we can measure these in financial figures, pounds, or we can measure it in volume, the amount of product. So we can distinguish between the volume and value of output in a country. The volume is the amount of goods being made and services being produced. Value looks at the monetary worth, so the financial values of these goods and services. And obviously what we'd want to say, looking at the terminology that we were using this morning, we would want to see more volume being produced that will cause more value to the economy. If we have static volume, the amount being produced is the same, but we just increase the value, we increase the prices, we're just going to see inflation. Okay, so what you want is more volume to create more value. You don't want to see static volume and then increasing value, because that is just inflation. All right, that's pretty much all I can say about that. Other ways that we can look at national income, you might hear a term called gross national product. If I can just bring up my cursor, GNP. Before I go through what GNP is, gross national product is the same as TNI, total national income, from this morning's lesson. So gross national product of a country is the value of all goods and services produced by domestic firms, both at home and abroad. So it will include our assets, British assets overseas, that Barclays Bank over in New York. And as a reminder, GDP this morning is domestic production by domestic firms and foreign firms operating on domestic shores. So if we look at the United Kingdom, domestic bank will be Barclays, a foreign bank will be Santander. But the key point is GNP, gross national product, and total national income are interchangeable terms. But regardless of what we're using, whether it's GDP, whether it's GNP, whether it's TNI or GNI, I've put there, so gross national income, meaning the same as total national income, we can divide any of those terms by the population to get per capita. One little issue with incomes here, this is limited in terms of data and as a way of comparing. You know, we said this morning we used per capita figures to look at standards of living, bits like that. But you could argue, of course, that because many people in these low-income countries, so I just want to check one thing while I'm doing this. Yeah, that's fine. Because many of the people living in certain countries, in low-income countries, have got informal jobs, they won't be given a financial record. So maybe the gross national product of somewhere like this morning, what did we say, Tukalau and Benin and the Central African Republic, maybe they are higher, but because people are working on their own land or cash in hand or, anything really, they're not actually recorded financially. But we'll go more into that as we move on throughout the year. So what I want to look at to finish things off, and this is, I feel like I'm so tired, I don't even tell I'm slipping down in my chair, is something called purchasing power parity, which actually sounds quite boring at the start, but actually we can make it a bit more interesting. Now, purchasing power parity is another way of measuring the growth or the strength of an economy. Put simply, it's a method that allows us to look at the relative value of different currencies. Currency is money. We use the pound, America uses the dollar, Europe uses the euro in the main, etc. But obviously we've got different exchange rates. So at the moment, £1 might get me $1.30. That means that the pound is strong. £1 might get me €1.09. That means that the pound is relatively stronger. What we do is the idea of exchange rates is set by the demand and the supply of money. So we know that £1 equals $1.30 because that is what somebody in Britain who wants to buy dollars is paying. For every $1.30 that they want, they're going to have to pay £1. If an American wants to buy £1 in a bank or in a cash exchange place, they're going to have to pay $1.30 to get £1. And these items change every day based upon strengths of currencies. And again, I keep saying this, later on throughout the year, we will look at what makes exchange rates change. What your PPP does is that it takes a country's real GDP and it puts it into per capita. It will divide it by the number of people within the country. It then converts this income, and this could be the GDP of Britain will be in pounds, the GDP of Germany will be in euros, the GDP of Canada will be in the Canadian dollar, the GDP of India will be in the rupee. So we're going to have different figures based upon different currencies, but it tries to standardize this. Parity means the same. It doesn't want to know that a pound can get us X. In another country, a rupee can get us Y amount of a good. It wants something in a set currency. It chooses the dollar. It's obviously an American idea. So that third bullet point, it converts incomes into dollars to allow a comparison between all countries around the world. And what this lets us do is, the fourth bullet point, it lets us see how much an individual from each country can buy given the average amount of income that they have for a set basket of goods. And I'll talk to you about the basket of common goods in a minute with a set example, but also based on the strength of their currency, because you would assume that the larger an economy, the more growth in an economy, the more demand there will be for the currency, for the money of that country, and therefore we should have a strong currency. So what this also lets us see is if the market sets exchange rates for money effectively, like I just said, an American's got to pay $1.30 to get £1. Does this PPP rate actually agree with that? Or is an American getting ripped off? Should they only be paying $1.25 for £1? But we'll see what I mean by that in a minute. Just to take you back to this morning then, people, something I didn't make specifically clear was the GDP figures we were looking at had been converted to PPP already. If you look, let's go on the CIA rank, it was all in dollars. So Liechtenstein, £139,100 GDP in the dollar rate. Qatar, $124,900 at the dollar rate. It's obviously easier for us to interpret than if each country had its own currency being used. You could have huge numbers, then you would have to go and convert these back to a common currency to make sense of anything. What that also means, quite sadly, is that GDP, so total output of somewhere like, so I've gone to the wrong place, the Central African Republic, each person is worth $700 to the economy, and that's an average. That's averaged out per capita. That would mean that the richest members of the Central African Republic are pulling that up. That would mean the poorest parts of our society, Central African Republic society, would be worth cents, pennies, whatever you want to call it. All right, now that's a lot of jargon. Okay, I want to talk to you about the Big Mac Index. You can look at this in your own time. There is the whole thing called burgernomics, and what it is, it's a way of trying to simplify down economics by looking at burgers, all right? What we do is that we take the PPP data, the purchasing power parity data of each country, we put it to the dollar rate, and we see how much it costs the average person to buy a Big Mac. I'm going to give you the maths on this because it will explain the next slide for you. In an exam, you don't need to worry about these PPP calculations, but I think for your own self-interest and to make the next slide make any sense, we need to know the maths behind it. So let's take some fictitious data. At the moment, the price of a Big Mac in the United States is $3.57, for example. For example, the price of a Big Mac in the UK was £2.29p. I had a Big Mac at the weekend with my son. I know that's not true, it's about £4, but we'll use some fictitious figures. So keep in mind then, in our fictitious example, Big Mac cost $3.57 in the States, the Big Mac was $2.29 in the UK. To work out the purchasing power parity, I'm going to show you on this bullet point. It's $1.56 to a pound. I've taken the $3.57, I've divided it by the pound value of £2.29. That comes out at £1.56. So every pound, based upon this PPP figure, based upon buying Big Macs and burgers, is going to get me $1.56. Imagine if at the same time the actual exchange rate, so if you went into a shop, a bank, a currency converters, not to buy Big Macs, but to exchange currency because you were going to be going on holiday, if the actual exchange rate was $2 to £1 at the time, we've got a slight issue. If we take the $2, which is the actual exchange rate, and we take away from it the $1.56, which is the purchasing power parity figure based on the Big Mac, and then we percentage change it, so we divide it by the 1.56, so it's new $2 minus old $1.56 divided by old $1.56, we get an overvaluation of 28%. What does that mean? The pound was overvalued against the dollar by 28%. It was too strong. Realistically, a pound should get us $1.56 based upon that Big Mac index. What it was actually getting us based on the open market and what banks were charging was $2. So we were getting 28% more value out of our pound than the Big Mac index than PPP would suggest. Basically, the pound is so strong, it's actually 28% too strong by the numbers. You're probably sitting there thinking, Neil, it's 5 o'clock on a Wednesday afternoon. I don't want to know about exchange rates. I've got 2 years to learn about that. Let's make this exciting. What we're going to keep in mind is the value of a Big Mac in one country. We're going to think about the strength of currencies, and we're going to think about how many Big Macs you can get. Let's have a look. So on the left hand side, here is your Big Mac index with $50 American. If we were in India, we could get 30 Big Macs. If I had $50, I went to McDonald's, I said, here's $50, give me as many Big Macs as you possibly can, I'm going to get 30. It says there on the left hand side, the Big Mac is worth $1.62 in India. If I was in the Ukraine or Hong Kong, I would convert my currency to dollars, and then I would take my $50 into a Ukrainian or a Hong Kong McDonald's. In the Ukraine, equivalent to dollars, a Big Mac's going to cost me $2.11. In Hong Kong, it's going to cost me $2.12. $50 divided by $2.11 for the Ukraine, I get 23 Big Macs plus a dollar change or something. And it goes down in Malaysia, down in China, etc. What does all this stuff mean? Well, let's have a look through on the right. Due to the low prices at the dollar rate, combined with an overvalued currency, an overly strong Indian rupee, if you take $50 to India, you're going to be seriously eating a lot of Big Macs. The price of the Big Mac is low. The strength of that rupee compared to the dollar. So you take your dollars to the States, you go to a cash converter, you go to a Western Union transfer, you go to an Indian bank, and you take that $50 and change it into rupees. You're going to get some serious value for those dollars in rupees, plus you're going to have a very cheap product to buy. So with $50 in India, you're going to get yourself 30 Big Macs. The rupee is a strong currency, probably too strong, probably overvalued compared to what the markets for money would suggest. Let's go down to the bottom right, Latvia. Okay, in Latvia, prices are higher than in India at the dollar rate. The currency, the euro, is relatively weaker than the dollar in this case. So the price of a Big Mac is $3, which is more expensive than India, which is $1.62. The strength of the euro relative to the dollar in this case is going to be lower. So with $50 American in Latvia, you only get yourself 16 Big Macs. In this case, the euro is undervalued against the dollar. That's another way of measuring the growth and the performance of an economy. I am not suggesting to you for a second that India has got an economy that is growing faster than, say, China, Luxembourg, anywhere like that, because they can get 30 Big Macs for $50. It's just a nice way of simplifying how we see growth, how we see the strength of a currency, and how we see the performance of economy. But I do quite like a Big Mac, so I may go to India at some point. All right. Let's scrub that then. I'm going to set you one piece of work for this afternoon. Simply speaking, this is what I want you lot to fill in. I want you to get me 4 definitions. Write them down here. What does unemployment mean? What does growth mean? What does inflation mean? And what is the trade current account? All right. If you Google current account, it's going to say something like the money that you put your the account that you put your money into. All right. By current account, what I mean is you could Google something like the balance of payments current account. It's something to do with exports and imports. Now, when we look at data in an economy, when data spotting or making use of data, we need to focus on 5 things, okay? You need to be mindful of the impacts of positive and negative scales, and we'll see that in a minute. So if ever an exam asks you to analyse a piece of data or to comment on the value of something based upon a piece of data given to you, you need to look for 5 things. Peaks, troughs, changes, overall trends, and timescales. Peaks are the highest part of the piece of data. Troughs are the lowest part of the piece of data. Changes is the movement from the peak to the trough or the trough to the peak. Can you identify any overall trends? Even though the data might be fluctuating all over the place, have we got an overall increase or decrease in whatever we're looking at? And in terms of timescales, how long is the data valid for? How long have we taken to go from a peak to a trough? All I want you to do is, for the bit of data that I'm going to show you in a minute, for unemployment, growth, inflation, and the balance of payments current account, the exports and imports, I want you to spot the peak, the trough, the change, an overall trend, and the timescale, and jot them down into that box for me. Here's the piece of data we're going to be looking at. No, it's not that. It's the Spanish rate of growth and unemployment, Spanish inflation, and the current account exports minus imports, okay? You can totally ignore those questions. You don't need to do questions 1, 2, and 3. All I want you to do is use this data to fill in this sheet. If you look at it, we do have minus percentages. These are GDP growth percentages in, where are we, 2008, 2009, we've got negative growth. The other thing to say for the current account is that at 0, for every export that you sell, you import something. As you go above, you're exporting more than what you're importing. As you go below 0, you're importing more than what you're exporting. So the Spanish current account, basically speaking, they have always bought more goods from abroad than they have sold abroad. In about 2012, 2013, they were selling more abroad than what they were buying from abroad. So we get a positive balance. Okay, hopefully that makes sense. All right, listen, I'm going to log things off then. I'm going to deadline this for 7:30 tonight. Simply, it's filling this worksheet. I'll set it as an assessed piece of work, and that's pretty much it. I think I might go and rest my voice for a bit because there's some serious croak going on. Good luck with it, people, and obviously I'll be around on email and Classroom, etc. if you've got any queries or concerns. I'll also post this all out to Classroom now. Thank you.